good. In easy money, make sure that you can do the debtors calculation, so cash flow received from customers. Make sure that you have a look in the movement in inventory balances. Make sure that you see that. Number 3, have a look at the depreciation calculation. You do not have to do in this question the cost price accounts because it is not needed. They only want from you cash from operating activities. So have a look at that calculation. And then very important, also look at the interest received, cum interest paid, cum interest receivable calculation. Okay, let's start quickly with the question. They give you an extract of the statement of profit and loss and other comprehensive income for the year ended 31 December 2015. They have normal stuff, gross profit, operating cost, finance cost, profit before tax, income tax, profit for the year. Other comprehensive income is revaluation of land and total comprehensive income. Then statement of financial position, land. There's an increase, but you will see that it's not actually required that we do the investing activities in this question. So be careful in what you're going to do in your answer. If they don't ask you investing activities, don't waste your time on that unless it's necessary. Plant and equipment cost and accumulated depreciation, inventory, debtors, loan Mr. Dangerfield, bank, cash, immediately claimable deposits. Now, what is important, if they did ask you the full cash flow question, cash and cash equivalents would have consisted then out of bank, cash, and immediate claimable deposits. So for that figure of cash and cash equivalents, that would have been at the end of the year 17,000, all three of them together, and at the beginning of the year it would have been 65,000, 70, 85,000, all those three together. Then ordinary shares, retained earnings, general reserve, and revaluation reserve. Long-term loans, current liabilities, income tax, creditors, shareholders for dividends. Extract out of the statement of changes in equity, opening balance, our total comprehensive income for the year, dividends, and transfer to general reserve. Now, let's just see what they ask. Prepare the following for easy money for the year ended 31 December 2015 in accordance with IAS 7. The cash flow from operating activities section of the statement of cash flow and the reconciliation of the profit before tax with the cash from operating activities. That's not cash from operating activities now. Okay. So they do not ask investing activities. They do not ask financing activities, so you do not waste your time with all of those. We are going to focus, number 1, on cash flow from operating activities. Cash flow from operating activities starts with cash received from customers and employees. Guys, I will add here that they have to actually specify it here that you will have, well, actually they did imply that because you have to do the direct method if they ask the reconciliation note. If they do not ask a reconciliation note, then it can be either one of the two. But because they've asked a reconciliation note, they imply that you have to follow the direct method. Good. Gross profit percentage is 20%. Very important for sales figure. Number 1 of additional information, payments to suppliers and employees were correctly calculated as 19,400 and 2,800. So where are we going to start in any event? And then we're going to take that figure and we're going to derive at cash from operations. And when we have cash from operations, we have to do the reconciliation now. So that's why they gave you that figure. They don't want you to waste any time and duplicate maybe any calculations. Okay, then they give you the following information that was included in my profit figure. Included there was loss on sale and donation of equipment 35,000. Credit losses expense 45,000. Interest received 85,000. And now this one, write-off of damaged inventory 20,000. Depreciation with a lot of question marks. Plant and equipment were bought with cash on 30 June 2015. Details of equipment sold and donated. See that one there. Equipment with a cost price of 8,000 and a carrying amount of 5,000 was donated to an old age home. Now, the first thing that we have to see here is that the accumulated depreciation on that was equal to an amount of 3,000. We don't have to do the investing activities, so all we are interested in is the non-cash flow items. And the non-cash flow item would have been what? It would have been this carrying amount would have been the donation amount, and that donation does not represent the cash flow. So we have to make an adjustment for that. Then what you can see there is that the actual loss was on the sale of equipment was actually 30,000 Rand, because the 35,000 Rand was equal to our loss and the donation. The donation is 5,000. Okay. Equipment with a cost of 350,000 and accumulated of 270,000 was sold to Mr. Dangerfield. So if that was the loss, then he could have added back that to derive at the proceeds. They do not ask the proceeds. Then creditors include the following: trade payables and then interest received in advance. Watch out for that one. The gross profit percentage equals 20%. So let's quickly start then with cash from received from customers, and for that we're going to need our revenue figure, which is going to be our 4,000 gross profit divided by our gross profit percentage, which is 20%, and that will give us then in actual fact 20 million. 4 million divided by 20% gives us a revenue figure of 20 million. And then we have to adjust it for the movement in debtors. But here you had to watch out because there was credit losses which was written off. There's your credit losses for the year which was written off, and the amount of credit losses was 45,000 Rand. So when we go back and we work out the movement in our debtors balances, it is not only the 1,205 less the 625. You have to adjust that for the fact that we haven't received credit losses, the credit losses written off of 45,000. So there are two ways that you can do that. You can either say, well, our closing balance is 1,205, our opening balance is 625,000, but from that 625,000 we haven't received 45,000. So therefore 1,205 plus 45, that is what the balance on that account would have been if it wasn't for credit losses, less is 625, and that also gives you 625, which is then an increase in debtors, i.e. an outflow of cash. The alternative way would have been to do a T account, and in the T account you would have had your opening balance of 625,000, that one, your closing balance of 1,205. Credit losses written off is a credit entry on your debtors because you actually decrease your debtors with 45,000. Sales, 20 million. So therefore the amount that we receive from our customers, 19,375, and we go and park it 19,375. Cash paid to employees and suppliers was correctly calculated 19,402,800. So we're going to park that directly 19,402,800, and that cash from operations then is the difference between the two of 27,800. Now they require from us the reconciliation note. So let's do the reconciliation note. And where does the reconciliation note start? With profit before tax. So profit before tax, 524,200. We have to adjust it, number one, for non-cash flow items. And they were very kind. They put in a lot of non-cash flow items for you here. The one is the loss on the sale of equipment, which was 30,000. The next one was credit losses written off, and that was 45,000. The write-off on the inventory, that was 20,000. The depreciation, we will have to go and work out. So if we just see and just write down what we have, profit before tax, 524,200, adjusted for separately disclosable items, adjusted for non-cash flow items. Loss on the sale of equipment, 30,000. The donation, 5,000. Inventory written off 20,000, depreciation we haven't done as yet, and credit losses 45,000. Let's park depreciation for the moment and let's quickly have a look at for the separately disclosable items. Interest received, the amount included in our profit figure, and that is the figure that we adjust now, was 85,000 Rand. So that interest received had increased our profit before tax. Therefore, if we want to take it out, we have to deduct it minus 85,000. Interest paid. Now they gave us in the income statement our finance costs. Finance cost was 75,000. In the income statement, included in our profit figure, 75,000. So that is the figure that we're going to add back to our profit in order to eliminate that. Let's quickly have a look at depreciation. Now, there obviously is no depreciation on land. Depreciation on planted equipment, if you're going to draw a T account, we're going to open it up with an opening balance of 740,000 and a closing balance of 840,000. Opening balance 740,000, closing balance is 840,000. During the year, a few things have happened. Number one, equipment with a cost of 8,000, the carrying amount of 5,000. We've already established that the accumulated depreciation of 3,000 was actually donated. So we have to take out the 3,000 out of the accumulated depreciation account. We do not have that equipment anymore. So in our accumulated depreciation, we would have taken it to the donation or the realization on the donation account, 3,000 Rand. Then furthermore, we have sold equipment and the accumulated depreciation on the equipment sold was 270,000. So that would have been transferred to an asset realization or disposal of an asset account, 270,000. Now that means if we balance off this account, then on the credit side, you would have derived at your depreciation charge for the year. Short and sweet, without any long calculations, 373,000, and you could have actually dumped it here as a non-cash flow item, depreciation, 373,000, which you have to add back. Now, once we have all these items that we're going to adjust our profit with, we are going to have a total of 942,200, and then we are going to do our adjustments in working capital. Adjustments in working capital. Now remember here, because we are doing the reconciliation note, we also have to include our movement in debtors. And our movement in debtors we've already calculated as 625,000. So movement in debtors, 625,000. Then our inventory. Now remember that there was a write-off in inventory of 20,000 Rand. Now what did that actually, the amount that we show in our statement of financial position for inventory was after the write-down has already been done. So we know that if we want to work out how much was the actual movement in inventory, or the amount that we actually spend on inventory items, we have to add back that 20,000 to derive at what the balance of inventory was before the write-down, which was 895,000. And that we are going to compare with the 405,000 of last year. So 875 plus the 20,000. Guys, this is very important. Less last year's balance of 405,000 will give you then your movement in inventory. There was an increase in inventory, quite a large increase in inventory as well, and that was an outflow of cash of 490,000. Debtors we have done. The other one that's still left is our creditors. And our creditors, there was also quite a substantial increase in creditors for the year, and that increase will represent an inflow of cash equals to the amount of 100,000 Rand. Now the total creditors on the statement of financial position was 375,000 and 255,000 for last year. But here they tell us in our additional information what the breakdown was for our creditors. They say that include trade payables, and clearly there was only an increase of 100,000 Rand in trade payables, and that is where that 100,000 and that 300 less 200 is coming from. The other amount there is interest received in advance. Now, we are going to work with that. You have to work with that when you're actually going to determine what was the actual amount in interest received. But we are not there yet. All we are busy with and kept ourselves busy with up to this stage was to adjust our profit before tax, with the amounts included in profit before tax. Okay. So that is why that interest income that we've accounted for was 85,000, because that was the amount included in our profit figure. Included in our profit figure, interest received of 85,000. Right. So now we can see whether we are actually reconciling. Here we get total cash from operations, an outflow of 27,800, and when we get here, there is our outflow of 27,800. It actually reconciles, so now we can carry on. Good. Interest paid. Now there's nothing funny about interest paid, so therefore we can use the full 75,000 Rand. Interest received though, we have just established that there was interest received in advance last year, as well as interest received in advance at the end of this year. So best is to draw a T account with interest received in advance. The opening balance is last year's balance of 55,000. The closing balance is the end of the year balance of 75,000. That 55 and that 75. In our income statement, we have recorded 85,000 Rand. So what was our accounting entry? We credited the income account and we debited interest received in advance with the 85,000 Rand. Now we can determine the actual amount received in the bank, and that's our balancing figure of 105,000 Rand. So the actual interest received was 105,000. Dividends paid. Guys, in our income, in our statement of financial position, we have shareholders for dividends. Opening balance 200,000 plus our dividends declared during the year, which was where did they give us our dividends declared for the year? Was then, just see, yeah, was 200,000 dividends included in statement of changes in equity, dividends of 200,000, and at the end of the year there is still 250,000 Rand outstanding. So that means in actual fact it is the 200,000 opening balance plus the 200,000 dividends declared during the year, less the outstanding balance at the end of the year, and that will give us our actual amount paid as dividends for the year of 150,000. The last one is our taxation paid for the year. We had an opening balance of 30,000, there it is. We had an income tax charge plus the 157,200, less the amount still outstanding at the end of the year, which is equal to 45,000. That will give us then the total amount that we've paid to receive of revenue as tax during the year. Opening balance plus our income statement charge less our closing balance. So in actual fact, we paid the receive of revenue 142,200. So our cash flow from operating activities, that is what the question asked me, was a cash outflow of 290,000 Rand. So important things in this question is the fact that you had to do the reconciliation note. Included in the reconciliation note, there were credit losses. Have a look how to treat credit losses. There was an inventory write-off. Have a look how to treat the inventory write-off, and look at the interest received as well as the interest income, and know and understand the difference between the two.